Hey everybody, and welcome to the third video of Chapter 3. If you remember, in the second video, we established 4 different types of basic debt instruments and the differences between each. In this video, we're going to build off of that discussion and talk about how we price them and make them comparable on the securities market. So first, we're going to talk about, at the basics, how to calculate a bond price. And then we're going to talk about one very important concept in particular called yield to maturity. And so, as I mentioned, and as we've talked about, coupon bonds, just like most other types of bonds, are tradable on the fixed incomes market. But they all have different structures, and so it's really difficult to compare them. So what we have to do is we have to price them somehow. And we calculate the prices using this example below. So let's say that we have issued a coupon bond with a face value of $1,000, and the coupon rate is 6%. This means that the coupon payment is $60. Additionally, it has a 48th month or 4-year duration, and the coupons are being paid annually. Then we can calculate the current price of the coupon bond using equation 1. If you look, using 4 annual coupon payments, we'll get a total of $240, plus at the end of the bond's period, we'll get the face value of $1,000 back. However, what makes pricing coupon bonds really tricky is that all these payments are coming in at different time periods. And to calculate the price, we have to back out the present value of each individual payment. And how do we do that? Well, we use the present value equation that we established all the way back in the first video. But we have to do that for each individual payment instead of the entire $1,240 as a whole. So if you look at this first term, all that this is the present value equation, but for just the very first coupon payment after 1 year. Then the second term is the coupon payment's present value after year 2, then after year 3, and after year 4, and then we finally calculate the present value of the face value after 4 years. And by adding all of these terms together, we can get the current price of the coupon bond. And just as a bonus for you guys, I felt like it was important to generalize Formula 1 into equation 2. And this is the notation and type of notation that you're going to be seeing in other senior level classes, as well as if you go on into any graduate level courses. So this is a good introduction into this kind of notation. This says the exact same thing. It says that the price is equal to the sum of all the coupon payments up until year capital N. So in this case, capital N would be 4, and we have the constant coupon rate, which is $60, over the interest rate raised to each individual year. So you have 1 and then 2 and etc. Plus the future value discounted by the interest rate raised to the maturity date, so capital N. So it says the exact same thing, just a bit different way to write it. But if you'll notice, I missed a very important detail, which is what is I? If we don't have the interest rate, we can't calculate the price. And with coupon bonds, I is called the yield to maturity. And the yield to maturity is just the interest rate that makes the present value of all the payments from an asset equal to the asset's price today. And so, unless stated otherwise from this point on, whenever I refer to a fixed income's interest rate, I'm talking about its yield to maturity. So, unless I make it very explicit, just assume that yield to maturity is what we're talking about. And you can just consider it as the rental rate of your money. When you loan your money out, then somebody has to pay you rent on your money. And that rent is set by the market. The market deems how valuable your money is. And so if there's one concept that you take away from this video, it should be the yield to maturity. So how do we calculate it? Let's now look at 2 different examples here, option 1 and option 2. So in option 1, we have a 3-year $1,000 face value coupon bond that is right now trading at a price of $1,050 and a coupon rate of 9%. Using the equation 2, we now have everything that we need to solve for I. So if you look here, you have the $1,050 current price on the market, and that's equal to the sum of the three discounted coupon payments plus the face value discounted to the present. We get an interest rate of 6.1%. However, in option 2, we have a 2-year $1,000 face value coupon bond with a price of $980 and a coupon rate of 6%. So it's charging us less to buy this bond. Going through the same math, $980, and this is a typo, the 2 should be on the top, sorry about that. We actually get an interest rate of 7.1%. So all else held equal, option 2 is actually considering your money more valuable by charging you a higher yield to maturity. And so if you were comparing these two as investments, you would actually want to invest in option 2 even though the price is less and the coupon rates are less. So yield to maturity can be calculated with all fixed income assets, not just with coupon bonds. And we're going to do this briefly with each one. First, with simple loans, they're very easy because the yield to maturity, you already know how to calculate. It's just the interest rate on the simple loan. So just running through this example, assuming that the present value of a bond or of a loan is $10,000 and it has a 1-year maturity with a 10% interest rate. We can just calculate back out the present value is equal to the future value over 1 plus the interest rate. And on a 10-year loan, the present value times the 10% interest means that in 1 year you're going to get paid back $11,000. And then you can just solve for I to get 0.1, which matches the interest rate in the first place. Now let's look at discount bonds, and they're quite similar. So we're going to add in one little extra piece, and that is to actually formally isolate I for you. So let's say that the future value is $10,000 and have a 1-year maturity, and that the market price is $9,200. We can isolate I here by using formula 4. And when we just plug and chug, we get a yield to maturity of 8.7% or 0.087. Now, the very last one of the 4 are fixed payment loans, and they're a bit closer in calculation to the coupon bonds. And we use equation 5 to calculate it. Remember that with fixed payment loans, there is no end payment. There's no face value that's paid at the end. Instead, they're paid out incrementally and consistently. So we're just going to use that same formula in equation 2, except we're going to drop that end payment. And so the loan value is equal to the future payment divided by 1 plus I to the n. So this is the exact same formula as equation 2, just without the second term. So if we're looking at a $100,000 mortgage, and that mortgage makes $12,731 in annual payments for 20 years, we can just use equation 6 and then back out an interest rate of 11.2%. Now, in closing, one of the big questions you guys are probably have is asking me, well, how do you isolate I in a 20-year fixed payment loan? Well, the easiest way to do that without going through, hard by hand math is just to use a financial calculator. All of you should have, some sort of financial calculator by now. And if you haven't used them or learned how to use it yet, all of them have a financial accounting function on it where you can just plug and chug all of these different numbers, the present value, the future value, the coupons, the interest rate, and the duration, and then you can back out whatever you're searching for. If not, you can either go online or you can also talk to me to figure out the best way for you guys so that it's easy for you to calculate I. And please do so before your quiz because these kinds of questions are going to be on the quiz.